Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at a portfolio from Franklin Templeton, specifically their multi-manager equity portfolio. Now, if you kick off with the holdings of this portfolio, we can see there's 7 funds and a very small allocation to cash. And we can also see that the largest allocation is basically to the S&P 500 with a 25% allocation. Thereafter, we do see other equity mutual funds and ETFs. And in fact, almost all of them do belong to Franklin Templeton, even if the name doesn't mention it. So for example, ClearBridge is part of that, Putnam, of course, and there's Templeton and Franklin Templeton again. So in fact, this portfolio of 7 funds actually contains 2 funds, which is the one from iShares, the one from JP Morgan, that are not affiliated with Franklin Templeton. Now, it's also worth pointing up front that some of these funds are just very expensive. So for example, the large cap growth fund from ClearBridge charges 73 basis points. There is the Putnam Large Cap Value Fund at 63 basis points. There's a Developed Markets Trust that's charging more than 1%, and so on. Now, let's look in terms of how this portfolio has performed, what has been driving its returns, and also if it can be simplified. Now, from a total cost perspective, this portfolio charges 46 basis points. And we do see that over the last 3 years, this would have outperformed the kind of auto-suggested benchmark, which is the MSCI ACWI. Now, we only have a short track record, which is due to one of the funds, the one from JP Morgan, the International Enhanced Research ETF, only being launched in 2022. Now, if you look at the track record over those 3 years, that effectively seems to indicate that this multi-manager equities portfolio has done well. But be aware that effectively these are only the constituents as of today, that we roll back in time. So we assume, right, this portfolio hasn't changed, which is an unrealistic assumption. And practically speaking is that most investors performance chase. So you kind of like add the funds that performed well over the last few years. So there's always a bit of a bias when it comes to using the current portfolios of model portfolios. Now, that's with regards to performance. If we do want to move on to a little bit in terms of factor exposures, now this is an all equity portfolio, right? So we do see that the beta to the S&P 500 has been consistently, almost close to 1. We do see that there is no bond exposure here. There is a negative bias to the US dollar index, and that simply comes from these international and EM funds. Some unexpected, again, very consistent. We also do see that there is some relatively consistent exposure to equity factors like value, right? You can see it's constantly positive. The exposure to momentum is slightly positive, 0 on average, but there are also consistently negative exposures to some other factors like quality, low volatility, or size. Now, it is worth mentioning that these factor exposures, despite there being some consistency, are very low from beta perspective, and that translates into these equity factor exposures from a risk perspective being insignificant. So here we see a risk sources analysis over the last 2 years, and we effectively see that almost all of the risks simply come from your stock market. The equity factor exposure was insignificant. So this is in terms of from a risk sources perspective and equity factor perspective. The next question is, from our perspective, how thoughtful has this portfolio been constructed? And for that, we can have a quick look at the holdings analysis. And so here, effectively, we see all the kind of like different funds in here, right? As mentioned, 7 funds plus cash. they're all equity exposures, we know that, right? But what I'm going to do is I'm going to zoom in over here to the factor exposures. And the reason for that is I already know that there are some funds in here that are likely to have conflicting factor exposures. So, for example, combining a value fund and a growth fund just makes no sense because they have opposing factor exposures, and we can demonstrate that. So, for example, over here we can see the ClearBridge cap fund, right? SBLYX, right? We can see its exposure to the value factor is negative because you own growth stocks, right? But on the other side, then you have these positive exposures, right, from international EM and also the value fund, right? Now we see the same thing from a momentum perspective. We can see positive exposure here, negative exposure here. From a quality perspective, we can see positive, negative, negative, right, very negative, and so on. So effectively, this portfolio is not very well constructed because it simply lacks focus, and it's perfectly fine to have, and actually recommended, right, to have factor exposures if you do want to have a achieve a certain objective, either outperform the market or provide better risk-adjusted returns. But you should ensure that the factor exposures don't net themselves off, because otherwise you're just left with holding expensive equity, right? And then you can just buy the S&P 500 or Russell 3000 directly. So this is the biggest critique of this portfolio. We can also ask ourselves, can this portfolio be replicated easily? And yes, I mean, over here we see a simple correlation between the MSCI ACWI and MSCI World. Provides you the same performance or a very similar performance. Again, the performance of this portfolio is slightly higher, right? But as mentioned, the model portfolio, we use the current constituents. And typically, in these cases, you have better performance chasing happening. So that kind of summarizes our review of Franklin Templeton's multi-manager equity portfolio. As mentioned, it's an all equities portfolio, has 7 funds, but a bit of cash. 5 funds are from Franklin Templeton, right? And they are just overly expensive. And you can replicate this portfolio with the MSCI ACWI or a combination of MSCI ACWI and MSCI World, and that gives you the same exposures. Hope that helps. Have a nice day.